During bull markets, most investors focus on return in its most basic form, without taking into consideration the risks they're exposed to in order to achieve said returns. Unfortunately for most, the risks aren't evident until after it's too late and the market turns sharply lower. For example, when the so-called FAANG stocks were outperforming the broad US market, investors may not have been focused on how rising rates could hurt the appeal of those mega-cap growth names. When US rates were at or near zero, investors were willing to pay up for the FAANG's expected long-term cash flows. But once the Federal Reserve started aggressively raising interest rates, investors became more focused on near-term cash flows and valuations. Risk-adjusted return is a critical element to successful long-term investing, and one often overlooked or misunderstood by newer investors. Risk-adjusted return is a calculation of the potential return on an investment such as a stock or corporate bond when compared to cash or equivalents. Risk-adjusted returns are often presented as a ratio, with higher readings typically considered desirable and healthy. One way to think of risk-adjusted return is that it's like the speed limit for your car. If your destination is 60 miles away, you can get there in just over 1 hour if you stick to the 55 miles per hour limit. Or you can get there faster if you're willing to drive above the speed limit. The faster you go, the quicker you could arrive. However, going above the speed limit increases your risk of getting a ticket, having to swerve wildly to avoid accidents or something worse. And the faster you go, the higher the odds of a bad outcome. The same is true of your investing. Building a diversified portfolio based on one's risk tolerance and investment goals may feel like a slow, even boring approach. That means it could take longer to reach your destination, investing goals. But you most likely increase the odds of getting there. Focusing on hot trends may seem like a faster route to your goals, and it may even be so for a time, but you also increase the risk of a financial accident.